This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
We got to move away from China, but that doesn't mean we're going to Texas. This week, we'll talk about who the real winners of the 2025 trade wars may be and review a busy week of important economic data. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the team's portfolio managers. And I stole a quote from CNBC this week that they had attributed to Jack Bogle. And I didn't always agree with Jack, but I don't know how a guy could argue most of his career for just blind indexing and then give opinions on what he thinks the market and the economy is going to do. But apparently he said, quote, "Don't just do something, stand there." End quote. And I like that. Maybe you've heard it before, but it was new to me, and I threw it around the office a couple of times this week. And I'll emphasize again today, as I'll reference back to a show I did 2 weeks ago and talked about reefing our sails in the portfolio. You react to information or a lack of information or a lack of conviction, you should react so in a nuanced way. And, don't just react to headlines, especially like today's, which shift so radically back and forth day to day. Don't treat them as a binary all in or all out type of way. If you came into this calendar year with too much risk, and the stock markets were doing very well, so your stock portfolio likely grew. And, if you carried way too much exposure into this year, more stocks than maybe you now wished that you had, or that you leveraged specifically to the very high-flying names, which have been very volatile, you may be in a tough spot. Less so today than a while ago, but, maybe you overreacted on the so-called Liberation Day and you sold into that. You sold a chunk of your portfolio into those major market pullbacks, which was erroneously called a crash by so many. I don't think it really in any way was a market crash. Well, if you did sell into that, though, you're probably regretting that today. But if instead you keep your eye on a long-term plan and you make nuanced shifts along the way, you focus on how much risk exposure you have, you look at the risk premium in the opportunities you may invest in versus the opportunity or the alternative of just taking on some yield and a less risky fixed income option. And part of that nuance could have been reducing some exposure to start this calendar year. As I said, your exposure is probably pretty high after 2 gangbuster years in the stock market, unless you are paring it back and selling along the way. And maybe now, if you did overreact, maybe now with the markets pulling back from their all-time highs, that you're a bit light on your stock exposure if you did pare back early in the year, to which you can then use some of the volatility to buy the names that you've coveted all along and buy them on the dip. But sometimes you can do nothing and just stand there, per that Jack Bogle quote. Now, there was a lot of economic data this week, and I saw mentioned from numerous sources, including a featured headline in the Wall Street Journal, that ultimately none of it's going to matter until we get to Friday's jobs report. But since I'm recording this show on Thursday, I'm going to give it my best shot, including and starting out with a preview of that Friday report for tomorrow, with the weekly jobs numbers that were released on Thursday, whereby we saw that for the last week of April, so this is a chunk of what that report will be tomorrow, jobless claims for that week were 241,000 people applying for unemployment versus the FactSet consensus estimate of 225,000 people, and continuing claims. Total people out of work are 1.92 million people versus higher than the estimate, which was for 1.86 million. Now, did the stock market hate all of this? It did not, because higher unemployment itself isn't a pure sign that the economy is doing anything really bad, although it certainly doesn't help the consumer confidence of those 2 million folks who are out of work. But it's really a sign that the Federal Reserve is feeling pressure to lower interest rates to fulfill that end of their dual mandate. And to that point, we also got the so-called JOLTS job openings data earlier this week. And it's a key reading of kind of the labor slack in the country. It's a sign of how much demand, how many jobs there are available. And if that number gets too big, it contributes to inflationary pressure. If there are too many jobs openings and not enough people taking them on, well, then you would have wage inflation. And with 2 million people on unemployment, this may seem odd, but those numbers don't necessarily match up. Not all square pegs can fit into round holes here. Anyway, for the March reading on openings, there were 7.2 million jobs available looking for labor in this country, which was actually lower than the FactSet estimate of 7.5 million and the reading for the previous period, which was 7.5 million. The combined points there indicate that there are, it's not a small number, but fewer openings available with more folks out there that are actually out of work, indicating maybe that industry is being cautious with expansion at this moment. If that JOLTS number soars, it's a sign that, one, industry is looking to expand, hire a lot of people, but also that there's pressure that wages would have to go higher. But that's not the case now. And they also combine to show a somewhat overall softening in the economy. And again, that points to a case for the Fed to want to lower interest rates to support the economy. Now, for some perspective on that, according to Wall Street Journal this past week, jobs openings have been declining since making a recent peak in March of 2022 when there were 12 million jobs seeking employment in this country, which, if you remember, that was a time when it was kind of this reawakening from the COVID lockdowns, and businesses were trying to get folks back to work, coinciding with that period of tremendous resignations and job flipping. I forgot what they called it, the Great Resignation or something like that. Well, that was a time when labor was completely able to dictate their terms, their demands to employers, and that led to a continuation of, even though people were working, huge numbers of remote workers, and that's now reversing to some extent. Well, does the Fed have room to cut rates here? They're still a bit wary of the effects that tariffs may bring, and because of that, they may wait longer than maybe they should. But we got their preferred measure of inflation also this past week, and I told you it was a week full of data. It just doesn't have that jobs report yet, but that core PCE reading, that inflation reading came out. It's an inflation reading of 2.6% for March, which was right at the estimate and lower than the previous reading for the previous month, which was 3%. So while the inflation rate hasn't yet achieved their 2% goal, they've also said in their readouts that their expectation was to reach that goal in 2026. And this appears to confirm that they're on that path, which gives them, again, clearance for a rate cut, maybe a quarter point or two. And for what it's worth, a lot of the analysts have been pointing to an interest rate cut in the June meeting, waiting for that to occur. But the Fed is meeting this coming Wednesday, May 7th. So we could see them lower their target then, or if they don't, we could look forward to seeing Trump yelling to fire Jerome Powell again, which the market hasn't particularly loved in the past. Finishing up on the data this past week, we got the April consumer confidence readout on Tuesday, taken by the Conference Board for the month of April, and it dropped further down to a reading of 86 versus the estimate, which was for 88, and the prior period of 94. And repeating myself from prior months, if consumers and CFOs in this country continue to lose confidence, then they're going to spend less, which leads to slowing economy and snowball effect. Scott Bessent, our Secretary of Treasury, said this week that he just doesn't look at surveys, and he didn't when he was an investor. He doesn't look at surveys like this one, but only at actual data. But he was also known for taking a very large macroeconomic hedge fund and bleeding out all the majority of its assets after a few years of pretty poor performance. So maybe he should have considered some surveys as well as a forward indication. He also said this week that the U.S. imports over 5 times as many goods from China than China does from us, which, he said, therefore, their tariffs on our imports are unsustainable for them. But, of course, that doesn't make any sense. The opposite would be true, since they don't rely upon importing much from us. Them putting up tariffs and trade barriers on those imports in retaliation attack those goods specifically. That's a tax on those goods and goods like agriculture, alcohol, automobiles. But their overall economy doesn't seem a dramatic effect from that, not in the same way that we would see from the broad reliance on imports from them. But there's a potential way for our industries, for our consumers, and for us as investors to pivot, to circumvent these effects. And I'm going to dive into that after a short break here. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Have the Magnificent Seven become the Lagnificent Seven? The clear leaders of the past 2 years are now bringing up the rear. Is this just a correction or something more? Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about these investment trends and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. So, the dominating news, practically drown out everything else in the markets these days, is obviously tariffs. Tariffs that largely haven't even been put in place yet. They've been postponed or delayed, and to what degree they do get applied and for how long is pretty much anybody's guess. But we have seen the markets rebound pretty nicely from the lows made shortly after the Liberation Day announcements and the enormity of the tariffs proposed that then shocked the investment world. Now, there's been holds placed on most of the tariffs being applied, and in other cases, the extent of them being rolled back, as well as numerous exemptions now having been announced and included to kind of dampen the effects there. What we haven't seen yet in a big way, though, has been any sort of specific bilateral agreement now resulting from this between the U.S. and another nation to eliminate the threat of tariffs. But we've started now, this past week, to get hints that we might start to see that soon. Now, it just doesn't look like we're going to get some massive breakthrough in China, at least not before the time you hear this podcast. But most of the news has been speculation about whether or not China and us has even discussed this topic yet. But it was alluded to by Secretary Bessent that we could be getting close to something in India, which makes a lot of sense and would have a major impact. And the point that Bessent made was that India has very clear tariffs in place against the importation of U.S. goods. And in this process, that's useful because it makes a negotiation rather straightforward. If you want to negotiate a deal when you're fighting against non-tariff barriers to trade, for example, the EU puts pretty big limitations on importing U.S. agricultural goods, circumventing free trade rules by saying we don't want anything that's GMO and whatever. That's a bit more vague, harder to negotiate, harder to get to an endpoint with. But with India, it's clearly more of a kind of equal tit for tat that let's get to a more transparent and open trading relationship here. And this is also important because of India's size, their scope, and geographically their location, as they can really fill a lot of the potential gap of production that may look to leave China on a more permanent basis. Now, it's not likely that we're going to see the majority of iPhones manufactured in Texas anytime soon. Howard Lutnick's suggesting that they're all going to move their production to Texas and be built by robots. Well, I really don't see that happening anytime soon. It takes a lot of investment and time to get that going, and I don't really see the point either. But this past week, the third-party producers of iPhones, because Apple doesn't really build the iPhones, they outsource it to companies like Foxconn. By the way, disclaimer, I own Apple. We own it for our clients. This isn't about Apple, but about production. But either way, little disclaimer there. But the third-party manufacturers, the companies that actually do the manufacturing, now have opened new plants in India with massive new additional capacity coming online soon, specifically to build iPhones for the U.S. market. And ultimately, with companies already having issues in China, having intellectual property issues, access to goods, transparency issues, it was already had some issues if you want to do major manufacturing there. The tariffs they're now facing and the advantages of India becoming more clear, along with India leading the way from tariffs to new open trade deals, India may prove to be the big winner of everything that's happening in the global economy today. Sprinkle on top of that, according to Barron's, exports to the U.S. from India only account for about 1% of India's GDP right now. So the tariffs on them doesn't really make a heck of a dent in their economy, but a pivot to them picking up the slack may be all pure growth for their economy. The same piece in Barron's mentions, in their sense, a negative way that India may find themselves flooded with cheap imports from China, who may look to dump their goods that they would otherwise have sold to the U.S. And, that would make domestic competition for some of these goods a struggle. But otherwise, it would be deflationary for the local economy, which is also very sensitive to specifically and now benefiting from a global plunge in oil prices, which is allowing the Indian central bank to cut interest rates for the first time, I think it was in 5 years, and starting to build momentum that may lead to them becoming the ultimate powerhouse for global manufacturing. Per Goldman Sachs report in the past week, India's central bank cut interest rates by 25 basis points in April and shifted from a neutral to an accommodative stance, putting a new priority on growth. And it's hard to compare apples to apples here, as their emerging economy can't be measured in the same way with our economy in terms of growth, in terms of inflation, interest rates, et cetera. But while we have this 2% inflation target, India now maintains a 4% inflation target, which is historically a pretty modest number for them. And they're below it now. Their inflation reading is a 3.6% inflation reading now. Per a Financial Times article from the fall, from end of last year, quote, the lack of adequate infrastructure, roads, ports, water, electricity, created painful obstacles to industrial development of all kinds. To its considerable credit, the government of Narendra Modi has tackled these issues. It has invested heavily in infrastructure, maintained budget discipline, and backed the Reserve Bank of India to control inflation and clean up the banks. Macroeconomically, India is now in good shape, with equity markets strong, credit available, and enormous tailwinds from India's youthful demographics. There are no obvious constraints, end quote. And what the final missing element may have been was the legacy of competitive advantage of industry that was embedded in China, well, with so much now of a threat. Because this article that I was just quoting was from obviously before the reality of tariffs was in place. Well, now we might have this push from the U.S. to make that Chinese embedded legacy of manufacturing that much less attractive, and India may now really be able to pick up that ball and start running with it. I mean, it's a big task. It's not something that's going to happen overnight. But with evidence like the case of the iPhone starting to be clear, India may have a very long runway for successful growth ahead of them. The one challenge that remains for us as investors is that it's hard to directly invest in it or to participate in it. And while I won't make any specific recommendations, I'll just say that while combing through a handful of dedicated Indian ETFs and mutual funds, they all look very similar in what they own. Their top holdings are, a different version of the same names. And they seem to fall victim to the same old problem that many emerging market mutual funds always seem to have, is that you're not really getting a great natural exposure to the emerging growth of the domestic economy, the domestic manufacturing, but rather you get a focus on the biggest and the most established, most liquid companies available, because that's what these funds kind of need to buy. So, they may overall still benefit from that secular growth, long-term growth from the overall direction of the Indian economy. But at the end of the day, a huge portion of the assets are going to be tied up in a handful of big banks, an energy company, a communications company, and maybe an IT name. And you're not going to get that pure organic growth that is described or I'm seeking from the story that's underlying here. All right, that's all I got for you this week. I hope you enjoyed the time you spent for the Wise Investor Show. I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.